Welcome back to Trading with CJ. We've got a slightly different video for you today. We're putting the growth, value and speculative stocks to one side, and we are talking about good old dividend investing. And I've had the pleasure of teaming up with Fifi from Fifi's Finance for this one today. Fifi is a UK investor as well, and I'm going to leave the link to her channel in the description below. Definitely go ahead and check that out as well. So we're going to be covering all things dividend, what they are, and some criteria to look for when picking dividend paying stocks. And we're going to give you 3 of our stocks that meet that checklist. But before we do, please go ahead and smash the like on this video and subscribe to my channel if you haven't done so already. It really is appreciated. So, over to Fifi.
Thanks CJ for having me on your channel. Hi guys, I'm Fifi, a mom engineer consultant living in London, and I make videos about saving money, investing and understanding the economy to make better financial decisions. So this video will cover the basics of investing in stocks for dividends. This is different from investing for growth and of course very different from trading. A dividend portfolio is there to generate an income with some certainty, and so we will highlight some of the factors we should be using to create a passive income portfolio. We need a disciplined approach, and so the checklist we talk about in this video is super duper important. Just a disclaimer guys, we're not financial advisors, though it's probably prudent to use some form of systematic approach to separate the wheat from the chaff, as they say. At the end of the video, CJ will give us his view on a few stocks that meet that criteria. So let's just jump right in. Passive income is the dream. To make money while you're dreaming. The idea that your money has been turned into a superhero called capital, working 24/7 to make you more money. And one of the key strategies to arm your money to do this is to purchase dividend paying stocks. And these are a subset of stocks that provide consistent payout to their owners for providing them, your superheroes, to work for them. For those newbies out there, so what is a dividend then? Well, dividend is payment to owners from the profits a company has generated. So to become an owner, you buy the company's stocks which make you an owner. As an owner, you're entitled to a share of the company's profits, and the profits that are paid to a shareholder as dividends. And the dividend itself is paid per unit or per stock. So the more stock you own, the bigger the percentage of profits you'll receive, or the larger the dividend payout to you. And companies can pay dividends monthly, quarterly, semi-annually, or even annually, though the most common is quarterly dividends that we've seen. Sweet as a nut, and a paycheck every 3 months. What more could you want? Now, the more shares that you do own, the more dividends you get, and the dividend is quoted as dividend per share. So the more shares, the more dividends. It's very simple. However, when comparing two companies, we'll probably be interested in how much dividend the two companies pay. So for example, and just plucking rounded numbers, so for instance, if you buy $100 of Apple, you get $1 in dividend. If you buy $100 of Johnson & Johnson, for example, you will get $3 of dividend. Hence, the yield for Apple is about 1%, which is dividend per share divided by the stock price. Whereas with Johnson & Johnson, it's 3%. So for a dividend investor, Johnson & Johnson are just more interesting, aren't they? So we will cover this a little bit later, but the motivation for a dividend investor is different from a growth investor, and that's what the key thing is. A growth investor would be perfectly happy if the dividend is lower, if the money is used to grow the company, so then the share price would actually compensate for the loss of dividends, and some, I suppose. So growth is generally seen as a riskier form of investing. So that's passive income, and it's so nice in a nutshell. And the dividend is really easy to get once the company pays the dividend. So it'll hit your brokerage account instantly as cold hard cash. It's so simple and so nice. So if you don't need the money, you can turbocharge your dividend investment by what we call drip invest, which is all part of the dividend reinvestment program. All that means is that dividend is used to buy more of the same stock, so that the following year you get more dividends, and so on and so forth. While I'm here, there are some awesome advantages to drip feeding your dividend. It's cheap, so reinvestment programs are encouraged by the companies and brokerages, and so available either free or very, very cheap. And with the advent of commission-free brokers, you can now also deploy 100% of your cash dividends with fractional shares. And we typically buy large cap. The large caps are the common shares offered as fractional ownership. And it can be automatic. So often you might switch your brokerage account so you don't even see the money in your account. Thereby, there's no temptations to go and spend all your dividends in one go. It's good discipline. And if you are buying automatically, you're acquiring more shares in rough markets and less in buoyant markets. And there is, of course, that automatic stabilizer, the dollar cost averaging, which is doing its thing in the background. Now, buying 1 to 2 dividend stocks is pretty risky. It's putting all your eggs in one basket. And as a dividend investor looking for passive income, diversification is your friend. So So the most easiest way to achieve this is through dividend ETF. How this works is you can buy one share of an ETF and have exposure to a bunch of different dividend paying companies. And one of my favorite platforms that has this is Vanguard, the high yield ETFs, which is paying about 4% a year in dividends so far. Right, so you may have noticed that the percentages are low in this type of investment. It's not a get rich quick scheme, unfortunately. And to be honest, no investing is a get rich quick scheme. I'm sorry guys. But over time, consistent contributions and reinvesting will build the pot nicely. So by the time you're there for retirement, you should be doing good. So then the big question is, what's a good checklist to follow? So here are my basic checks, and feel free to comment down below what yours are. The first one is to pick large caps. So stocks from the primary indices in your market. So for the UK, it would be the FTSE 100 and maybe the 250. For the US, it's the S&P 500. So look for yields of less than 8%. Excessive yields do make me a little bit nervous. So if it sounds too good to be true, it normally is. Those safety checks in place, please. Then with dividend paying stocks, we're investing for the long term. So we need a few things that indicate the robustness of the stocks you hold. The first technical point is gearing, and this indicates how much borrowing a company has, also known as debt to equity ratios, and this should be about 50% or less. The second one is dividend cover. This tells us how much earnings there are to cover those dividend payments. If it's more than one, that typically means that they don't have to use their reserves, which is good. If say it's greater than 1.5, then that provides a nice buffer. Then the current ratio tells us if a company can pay its debt now. And what I'm talking about there is when something scary happens, like, you know, a global pandemic. Again, a value greater than 1 is perfect. Then you do have to do a few advanced checks. So with the screening tools that I personally use, there are a couple more checks I can implement, which include things like the Piotrowski F-score. Amazing. This is actually a ranking score devised by a very smart chap that uses a number of metrics and ranking systems to decode how safe the finances of a company are, and more details on the interwebs out there. However, for the purpose of the screen, we want it to be 7 or higher. The final advanced check to look out for is the beta, and this is a volatility measure, and this tells us how the company will move to the market. People generally argue about how important this is. However, for dividend investors, low volatility is important. So we will say look for stocks with less than 1. Before I wrap up, I should talk about the Z score, and this is a little bit like the F score. It's a ranking system used to predict bankruptcy within 2 years. Again, there's a lot of information on the interweb to explain it. The maths behind it is, suffice to say, a Z score of greater than 2.6 is considered safe. Now, over to CJ to talk about the 3 stocks that meet these parameters and that we should be looking out for now. Cheers, guys.
Okay, so the first company up here is one you've probably heard of. It is an online trading platform predominantly involved with CFDs, contracts for differences, and it's called Plus 500, and its EPIC code PLUS. It has a market cap of 1.5 billion. So let's have a quick look here at its share price, and ultimately we're paying for dividend companies here. So the share price is not the be all end all, but you don't want this to be declining year after year, and Plus 500 is not. It's had very nice growth for the last few years. At the time of recording this, it's currently around about £14.50 per share. And we can see over the last couple of years it has been growing nicely, which is what we like to see. Although there was a sell-off back in February in 2019, and that was to do with a profit warning issued by the company. The EU was basically cracking down on CFDs, etc. It basically caused a sell-off in the stock. And since then it has gone on to recover, and it's pretty much back now at those levels again. It is making a profit, and it's got virtually no debt on its balance sheet, which is what we love. We don't want there to be much debt sitting there, and Plus 500 definitely doesn't. It has a dividend yield of 3.28% with a payout ratio of 35%. So now let's go through some of our checklists. We've already covered the debt. It doesn't have any. We look at the dividend cover. It needs to be over 1.5 is what we'd like to see in this company. And we can see here 2020, 3.32. That is very nice indeed. And even if we go back to about 2014, 2015, it's always been above the 1.5, which is very good. And we can see the current ratio for this company as well, 7.14. That is amazing. Very high current ratio there as well. Now we're going to look at a couple of our scoring systems. Fifi spoke about the Piotrowski F score, which is how safe its financials are, and the bankruptcy score, the Z score. How likely is this to go bankrupt in the next 2 years? And both of these are huge ticks, okay? It is extremely safe. The health score on this is 9 out of 9. You don't get much better than that. Very good financials indeed. And the bankruptcy score is extremely safe as well, 37.95. That is huge. And the last metric that we're using here on our checklist is the beta score, okay? How volatile is this as a company? Like Fifi said, if this is less than 1, It's not that volatile. It's pretty good. This is going to change on a daily basis, but at this moment in time, it is 0.39. Okay, it's going to kind of hover around that. It's not a very volatile company at all, unless of course there's a big crash or something like that. But yeah, it's looking very safe. Financials are good. It's been growing and growing. It pays a nice dividend yield. Plus 500 is company number 1. So number 2 here is called Ultra Electronics, Epic code ULE. This is quite a unique and different company, and it's in the aerospace and defense sector. It focuses on communication technology, security, combat management systems, control systems. Well, if you go onto their website, it's got a video on the start. You watch that video, it's very cool. It breaks down the company in a lot of detail with all the different things they do. There are so many different things going on in this company, all merged into one. It has a market cap of £1.5 billion. Its current share price is £20.72, and we can see here it has been growing nicely over the years. This is the 3-year graph. You can see steady growth. It's not that volatile really, and that is what we like to see within these companies. It also has very good financials, and it is making a profit, and it has very low debt, around about 32% debt to equity, which is below that 50% threshold that we'd look for. Its current dividend yield is 2.62%, which is once again a nice dividend yield. And on top of this, it has been paying it out and growing it year after year for 10 years plus, which is a bonus, of course, when investing into any dividend stock. And how safe is that dividend? Well, its current ratio is 2.01, which is more than we'd like. And can they pay off all the debt right now? Yes, they can. The current ratio is 1.63, which is pretty good as well. It's above the threshold, which is a big old tick. So how does it fare on the F score? How healthy is this company? Well, it's scored 7 out of 9. That is very good, which shows it is very healthy indeed. And the Z score, how likely is it to go bankrupt? Is it above our 2.6, which is considered safe? Yes, 3.16. So this is considered safe. And the last thing we're looking here on our main checklist is the beta score. How volatile is this company? We don't want it to be shooting up and down, left, right and center. We want this to be pretty stable. Is it scoring below 1? Yes, at the moment beta score is 0.52, which is half of that, which is amazing. So this is not a very volatile company. It is growing in share price over time. It's paying a nice dividend that has been paying out and increasing year after year. It's considered pretty safe. I'd say that this one is an exciting company and a good old dividend payer. Now, I just want to say that, of course, when you are buying stocks or investing into stocks, you should always do a lot more research in this, but we're just giving you the basics here, looking at our checklist and some of the key principles that we look at when investing into dividend companies. So far, 2 out of 2 have met that. We're on to number 3. And that company is Sage Group, Epic code SGE. Now, I probably don't need to explain this if you're from the UK, because it's a big old company. It has a market cap of 6.4 billion, which is very big here for the UK indeed. This is a software technology company, and it provides solutions and business management products for different companies, whether that be accounting, payroll, cloud-based solutions, or managing customer data. Now, Sage currently trades at £5.82 per share, and this is a slightly different graph to the other companies. It's not a straight up growth like that. It has had a very tough year, and when you look at this, it's had a couple of crashes. We had the crash in March, and then we've seen a sell-off as of late as well, and that's basically to do with their profits. Their profits are down on the previous year, thanks to what's gone on. Basically, it's been hit hard, but that doesn't necessarily mean this is a bad investment. The management have come out to say that they do think this will trend upwards in years to come, and I do think so as well. Okay, this has been a tough year for many companies out there. Now, they are making a profit, but the debt to equity is just within our criteria, 50% or so, which is pretty good. The dividend yield on this company is also very good, 2.96%, which brings us to the dividend cover, and it currently sits at about 1.65, and the current ratio is 1.23. Not the highest current ratio, but it's more than 1, which is good. This is a very big company within the UK. And how does it fare on our rankings? Well, it smashes the F score, 7 out of 9. This is healthy indeed. And bankruptcy, once again, we have a nice, safe company here. Don't see any risk of bankruptcy in the next couple of years. Currently at 5.24. And although this suffered the March crash, and then of course it's selling off as of late, as we spoke about, it is still quite low volatile company. Okay, it's a low volatile company with a 0.66 beta score, and it's paying a nice dividend. I do feel like the share price will sort of recover in years to come, so it could be a good dividend investment. So that right there is dividend investing in a nutshell. We have covered what it is, why you might choose this strategy over some others, some criteria to look for when picking dividend stocks, and 3 of our stocks that meet that checklist. I want to say a massive thank you to Fifi for teaming up with me on this one. And also, go ahead and check her channel out. Links to her channel is in the description below. Support Fifi and support the community. We're also doing another video on her channel in just about a week's time, so stay tuned for that. And if you have enjoyed this or found it useful, please go ahead and smash a like and subscribe to my channel. All support really is appreciated. Thanks for watching, and until next time.